Is there a subprime credit card crisis on the horizon? Hi, everyone, and welcome to another episode of Insights brought to you by Ainslie Bullion and the Gold and Silver Standard. Today, we welcome back Branko, who's been digging into another disturbing set of debt numbers, this time related to consumer credit and in particular credit cards. How are you going today, Branko?
Good, Chris. Thanks for having me back. Keen for today's discussion.
Yeah, it was a interesting article in the news today. Lots of really, well, as we were just discussing before recording this, quite disturbing charts and analysis going on in there, which is an area you love to bring to our attention. So glad to have you back to talk about this stuff. Let's look specifically today. You were talking about Macy's, and that, for people who aren't aware, is one of the largest retailers in the US, isn't it? So it's a big player. And they had second quarter results coming out that showed some of these concerns that you were talking about today. So can you maybe give us a bit of background who Macy's are and why it's relevant, that information you found for us today?
So basically, it all started a couple of weeks ago when Macy's released one of the largest retailers in the US, like their second quarter results, and their stock price plummeted. And basically, they were like, "It's not our fault. It's like consumers' fault they aren't spending because they're in all this credit card debt." And so their credit card purchases went down by like 30%. And they're like, "This isn't a Macy's issue. This is a systemic issue."
Yep.
So that's kind of the birth of what today's topic is. Is like, okay, let's actually look at this systemic issue and what is causing it and what is the current situation in the credit card market. And as Macy's discussed, and as we'll get into, it is quite bleak at the moment.
Okay. So, I mean, it makes sense if you've got retail having some issues that is as close as you're going to get to the man on the street or the people on the ground, because people going into those shops are making their spending decisions every day. So it is pretty important data to look at. Can you maybe give us that little bit of a deep dive into what that data is actually saying around the bigger picture of US credit? Because I mean that impacts everything really, and even though we say it's a US issue, it's something that does flow through to here. So it's something we really need to understand.
Yep. So I'll just get into one quick point actually I want to make is the reason that like Macy's or retailers is such a good reflection of the credit market is because when people's expenditure goes down, like the first thing they're going to drop is like clothes and retail stuff like that.
Yep.
They're not going to obviously drop their food and their petrol. So that's why it's a good kind of proxy for the start of a potential move. So basically, I'll just get into some of the data now. So there's this thing called the delinquency rate. I'll put a couple of charts up as well. There's a thing called the delinquency rate, which measures the amount of debt that is past due. And basically subprime credit card holders, their delinquency rate is going up significantly high, which means that they're obviously the most vulnerable back bracket because they have the lowest credit ratings. So basically, if a lot of their debt is kind of passing due, that's, imagine like a pyramid, like at the bottom of the pyramid, and then if they go, everything collapses.
Yep.
So that's quite concerning. And then the other thing I would say is you look at the average interest rate for credit cards right now, and it's gone like full vertical. Like this is crazy. Like you look at a chart, a normal chart, and then recently, obviously coupled with the interest rates, and then coupled with people not paying their debt, that delinquency rate, you see this massive increase in the average interest rate on credit cards, and that is quite alarming because if people couldn't pay it back before, they're obviously going to find it very difficult to pay it back now. So, and the other thing I would say is credit card days past due of payment, that's going up as well. So a lot of alarming numbers paint quite a bleak picture.
And just to sort of follow on from that, I think that is the connection that you can make to Australia as well, because a lot of these, particularly when it comes to credit cards, the rates and the banks that are actually backing those cards are often international in nature. And even though you might be getting a card here in Australia, it can be directly correlated to what's happening to particularly the credit card rates over in the US, I think. So there are flow-on influences right around the world with this stuff, because it's a little bit of a opaque market, isn't it? You don't really see that sort of straight pass through that you normally see from banks, because the rates are varied. There's no consistency. Some rates are extraordinarily high. I mean, what were some of the numbers you were seeing there? They were like
24%.
Yeah, like well above what you would expect from any bank.
Yeah. So obviously banks want to make their margins, with interest rate rises. And obviously when it comes to the standard mortgage rates, they add their little bit, so if it's
Yeah.
0.25, then 0.3. But these credit card interest rates, they can be a lot more liberal. So they have a lot more opportunity to really increase their margin, and that obviously negatively impacts consumers.
Yeah, it's definitely one that can be quite concerning if you're stuck in that reliance on them. So looking specifically at the banks, what effect does this have on them? Because you've mentioned them already and saying that there's sort of some impact going on there from a slowdown in consumer sort of spending, but also the impacts of that flowing through to credit cards. Is there something going on there, particularly around those smaller regional banks? Is this still related to Silicon Valley Bank stuff we saw earlier in the year? How do you place all of this together?
Yeah, so one key point I want to make is among the top 100 banks, the delinquency rate that we discussed earlier has gone up from 1.71 the previous year to 2.63. And this particularly affects like smaller regional banks because, as we discussed a couple of weeks ago, they had a bunch of kind of small banks in the US had their credit rating downgraded. So they're already on rocky terms. And then you see people not pay their credit card debt fast enough. They don't necessarily have the liquidity of some of the larger banks to hold the fort down and be able to manage that. So it is concerning. And again, we could see some of the smaller banks go down because people don't pay their debt. So that's just another thing to follow, which ties into a previous discussion we've had where, it's going to affect obviously people first, obviously, number one, and then it'll affect the smaller regional banks that level up. And then from there, obviously, work its way up to the higher players.
That's actually something I hadn't really thought about till you just mentioned it then. We've seen a lot of what I would call bailouts from the things that have happened previously where it's been bond related. So banks that are sort of underwater with their government debt, the government has effectively bailed them out with the program where they were buying it back, and they can step in and solve that, but they can't really step in and solve consumers defaulting on their debt. That's a real issue that they don't really have that sort of direct ability to deal with. So it's a really good point that you're making with those smaller banks. If they're relying on that, they don't have an easy exit on that particular
And of course,
issue.
smaller banks won't get bailed out. They're not like
Well,
SME.
yeah, good point. They might not get bailed out at all anyway.
Consumers never get bailed out. Small banks won't get bailed out. So they're going to be the first to go in a situation where consumer debt just skyrockets and they're unable to pay. And then we could see it impact some of maybe the bigger banks that have large, positions in some of these, smaller banks.
Yeah.
And then they'll get bailed out, obviously, because, that's...
Yeah. Well, they get bailed out when they buy out the smaller banks or take them over for cents on the dollar. that's what we've seen happening.
Or they'll come out with some deal like we saw with UBS a while ago where they said, oh, it's not a bailout, it's like a restructuring. But, at the end of the day, we all know what it is.
Yeah, it's pretty clear what it actually is. So bringing this all together then, what do you think the future holds? Have you got some sort of things we should be focusing on moving forward? How do you wrap all of this up practically for us in terms of how we should be thinking about it?
So pretty simply, I think with a lot of these things in the short term, probably going to be much of the same and not much is going to change. However, I think that if this data continues to get like parabolic, at some point the bubble has to burst. This is unsustainable. Now, I'm not going to have a prediction as to when this happens because you have people that like Peter Schiff who just try and call everything like it's going to be the end of the world one day. But like realistically, people just can't keep not paying their credit card debt, and then interest rates can't just, if they're paying back 30% a year, like at some point that becomes untenable and they have to default. And there will be some kind of mass defaulting, and then it's up to governments and how they're going to play that. So short term, probably much of the same, but then at some point, whatever the timeline may be, there is going to be a big reckoning with this because it is just impossible for people to pay these interest rates, and they just basically keep borrowing to pay the previous credit card debt. That's what the data looks like.
Yeah.
Like, explain to me how interest rates and debt go up. They just keep borrowing. People are acting like the US government now. To pay their debts. So at some point, unlike the government, they just can't print money. So
that's the
they're
key,
going to
isn't
have
it?
to pay for their mistakes.
Yeah, it's one thing when the government does it and they can just solve their problem by printing more of it, but for the people on the ground, that's not great, because that's not how the world works. And it's probably really quite unfortunate when you talk about modeling good behavior that the governments do behave that way, because it's not really surprising, is it, that people think, well, I'll just take on more debt if that's what they're seeing from their leadership. Like, it's really not a great picture.
Yeah, it's an interesting point that, like, you have your leaders basically do what we're not supposed to do, and that's like the example being put forward. Just keep borrowing debt. Don't worry, just go in a hole. But at the end of the day, yeah, we can't just print money from a machine. We got to go out and make it. Yeah. So
it's do what I say, not what I do, going on there. I think.
You like summarize.
Well, Branko, thank you for that today. Another insightful look at what's going on in the market as usual. So appreciate that.
Thanks, Chris.
Thanks for watching, everyone. Remember, reach out with any of those questions or comments on those social platforms, and we'll get back to those. I want to play around with those video responses if I get some good questions that I can think I can answer. So happy to take them on board. That's us for today. We'll be back tomorrow with Sam to discuss all things markets and metals. Until then, have a great rest of the day, everyone.